What if I told you I could save you thousands? Most new investors trip over 5 simple mistakes. 5 simple ones. Plus there's a sneaky extra one which I've included as a bonus for those of you who want to stick around to the end of the video. Give me a little over 10 minutes and I'll equip you with what you need to keep more of your own money. Let's go. But just before delving in, I want to tell you something. 95% of people who watch my channel are not subscribers. To reach more people and help them in their quest to become better with their money, can I ask that if you're not already a subscriber, to hit the subscribe button? It would really help me and the channel out. Thanks for doing that. Now back to the video. Number 1, fees never rest. Fees are certain, returns are not. So if you pay 1% a year on £10,000, that's £100 gone whether you win or lose. There's an easy way to deal with that though. Pick an index fund. An index fund is a broad category of investments, a broad basket of investments if you will. Pick one that charges 0.2% or less, particularly if you're a beginner. I'm invested in funds that charge less than 0.07%. And I know I've been through the motions of thinking it's the performance that matters, right? Not the fees? Stick around, I'm getting to that. Another fee to look out for is the currency swap. A US fund priced in pounds still converts those pounds into dollars inside the fund. It's just hidden from sight. You pay for that swap on the way in and on the way out when that money, that investment, those investment funds are eventually delivered back to you. But I bet you don't know how much you pay for that currency swap transaction. You know how much you pay when you convert pounds to dollars or pounds to euros or pounds to whatever when you're going on holiday, right? But you don't know how much you're paying for this conversion within the fund. I know it feels good to be investing in your own local currency, but just know that that feeling costs you, and it doesn't need to. Whatever type of fund I'm investing in, I will try to ensure that I'm always investing in the local currency for that fund. These are just some of the fees that funds and ETFs charge. There are a myriad of other fees that are charged during your participation in an investment like this. It doesn't mean don't do it. It just means go in with your eyes open and try and minimize those fees wherever possible. Now let's get back to that question about performance versus fees, because I know it's a big one. Old results, or what's often called past performance, about a fund, an index fund or otherwise, or an ETF's last few years, can be a bit misleading. Fact sheets often leave out platform, dealing, and FX costs. So the real gain is smaller than it shows you. So that's some of that performance versus fees part. The other bit is how much you're actually paying when you're paying a fee. You think 1% is small? You think it's tiny? Let me take you through a quick, simple example to show you why that 1% is actually much bigger than you think. Put £10,000 into the market for 30 years. And let's assume that market grows at 7% a year before fees. So with zero fee, if you had direct access to the market yourself and you wanted to go directly in and not charge yourself a penny, which none of us have access to, that pot of money, that £10,000 will be worth £76,000. Now let's assume you put that £10,000 into a low-cost index charging 0.2% a year. That £76,000 would be £72,000 now. That's the impact of the fee. Now let's assume that the fund you invest in charges 1%, not 0.2% anymore, but 1%. Your total return now, after 30 years, would be £57,000. £57,000. That's £19,000 lost to fees. So that small 1% fee hasn't just cost you 1%. Well, it has cost you 1%, but it's not the 1% you think it is. I bet you never thought that 1% would cost you £19,000. That 1% fee has sliced roughly 1/4 off your final pot. And this is just with a nominal £10,000 as a starting investment. Over your investment lifetime, you will likely have invested many times more than that. So imagine how much of your investment pot that the fee would take. And this is because the fee is compounding. It's compounding against you, not in your favor. It's compounding in the investment firm's favor. The fee is taken every year on a balance that just keeps getting bigger and bigger. So naturally, the bite grows and grows. My rule is, if a fund or an ETF can't beat an index fund after all costs, and most can't, in fact, almost all can't, then I prefer to keep more of my own money working for me and eventually coming back to me. And I choose the index fund that tracks the market, that acts as a tracker. It doesn't do anything else. It just tracks the market and grows with it, grows my wealth with it. Okay, mistake number 2. This is the same basket problem, or what I call fake diversification. Many people buy a tech index fund and the S&P 500, believing that they're diversifying and they're safer because they're spreading risk. But in reality, the big tech names already dominate the S&P 500 anyway, as well. So you've kind of bought the same basket of stocks twice. Let's look through just 5 stocks. So one tech-only fund I picked, the Nasdaq 100, Nvidia makes up 13% of it. But Nvidia also makes up 7% of the S&P 500. Microsoft makes up 13% of the Nasdaq 100, the tech-only fund. They also make up 7% of the S&P 500. Apple, 11% of the Nasdaq, 6% of the S&P 500. Amazon, 8% of this tech-only fund, 4% of the S&P 500. And Meta is 6% and 3%. Add those up, and more than 50% of a typical tech fund like this is the same 5 5 companies that make up 27% of the S&P 500 at the last time I checked. So what this means is when the market wobbles, the very thing you're trying to diversify against and protect yourself from, both funds usually move together. So your diversification dream, it vanishes. It's gone. It doesn't exist. Or at the very least, not anywhere near to the level you think it does. And I know many of you at this point are probably thinking, I wouldn't do that. I know that tech funds make up a lot of the S&P 500. I know that. And maybe you like to spread your risk geographically instead. So let's look at the global fund overlap as an example. You might pair the Vanguard FTSE Global All Cap Index with an S&P 500 tracker and think global plus US equals balance. But let's look at the global fund's top 10 holdings. Oh look, there's a couple of familiar faces. Microsoft, Nvidia, Apple, Amazon, Alphabet, Meta, Broadcom, Tesla, Berkshire Hathaway, and a company called TSMC, the Taiwan Semiconductor Manufacturing Company. So almost 20% of this global fund is already the same big US stocks. As we just saw, you don't hit a non-US name until slot 10. If this diversified list, this supposedly diversified list, has the same companies in it, then you're doubling down. You're not diversifying. And there's probably more US companies down the list of the total holdings as well. We just looked at the top 10. And this makes sense as well, because the US has some of the most profitable and most valuable companies in the world. So naturally, they'll make up a larger part of a global all-cap index. So here's some tips that I use to spot overlap very quickly. Open each fund's fact sheet. Scan the top 10 list. Lots of repeats amongst the funds that you're thinking about investing in. If the list has a lot of the same companies in it, then as I said, you're doubling down. You're not diversifying. When I diversify, I mix different assets. Bonds, smaller companies, non-US companies, cash. And even when I say non-US companies, I invest directly in non-US markets to diversify. This gives me better diversification. Okay, mistake number 3, missing the ISA shield or tax wrapper shield. You can put up to £20,000 a year into a stock and shares ISA in the UK. Inside it, all gains and dividends you earn that your investment earns are completely tax-free forever. And you don't have to put the full 20k in. A lot of people think that it's a £20,000 limit, so I have to put £20,000 in. I don't have £20,000 to spare. But I said you could put up to £20,000 in it. When I first started investing in an ISA, I had nowhere near £20,000 a year to put in it. In fact, there was one year that I only put £500 in it. In the entire year, you can put up to £20,000 in it. Anything from, say, £10 up to £20,000. All dividends, all increases in your investments within this ISA are tax-free. If you just use a normal investment account, a GIA, a general investment account, then any profits or dividends you make or any earnings you make within those investments can be taxed, i.e. you're probably going to owe tax that's payable on them. Sometimes this is taken out sourced by the investment company, and sometimes you might need to file your own tax return. Always get independent financial advice for your own circumstances. And of course, do your own research and due diligence. But why pay tax at all if you can just open a stock and shares ISA? That's what it's there for. And if you're thinking, I don't get ISAs where I am, I'm not in the UK, then ask around. Ask other people in your country if there's something equivalent. Mistake number 4, and that's guessing the market. Jumping in and out of the market can make you miss the best days. Research has been done which shows that if you miss just 20 days in 20 years, just the 20 best days in a 20-year period, then your eventual returns could get cut in half. I'll link to a video, a very short video, a 2-minute video that I've done on that particular topic somewhere over here. Probably over here actually. And whilst you're on the sidelines, it can make you miss out on earnings in your time out. That is when companies announce profits and pay their shareholders dividends. To be part of that shareholder group that gets paid those dividends, you need to be in that investment at the time those earnings are made. That part's pretty simple. Jumping in and out also means that you pay more costs. Every buy and sell adds some sort of dealing fees and spreads. These are just more leaks from what could be your eventual returns. More transactions equals more transaction fees if you keep diving in and out, trying to guess your way to the right time to get in and the right time to get out. This mistake has a very simple fix in my mind. Set up a monthly payment into your investment, into your fund or ETF, and then ignore the noise. And start at any level, £25 a month, £50 a month, £200 a month, or whatever fits. And simply adjust that amount as life circumstances change. Just remember, over almost any 10-year or longer stretch, staying invested beats hopping in and out. Mistake number 5, not letting time work. Money in investments grows like a snowball. Slow at first, and then it gets faster and faster and faster. But if you get out too early, at the slower stages, you'll never experience that speed. Again, let's take a small, simple example. Let's assume you invested £5,000 at 7% a year of growth, i.e. in a market that grows at 7% a year. After 10 years, that would be worth £10,000. It would have doubled. After 20 years, it would have doubled again, and it would be £20,000. After 30 years, it would have doubled again, and now it would be £40,000. So in the first 10 years, it grew by £5,000. In the second 10 years, it grew by £10,000. And in the third 10 years, it grew by £20,000 without adding a single penny more. Switching funds or investments every few months or even years can feel like you're doing something. Activity sometimes can feel rewarding, but it breaks the snowball. You miss out little chunks of time all over the place, and your compounding growth fails to work for you. Don't break the snowball unless you really need to. Let time work and stay in unless you really need the money to pay for something. And for those of you who have watched this far, here's a bonus one for you, a bonus mistake. You might have heard of AC or INC funds. This is one trap that catches a lot of beginners. Share classes. Most funds come in two flavors, and that label can sometimes be tiny on that fact sheet. The flavor you pick controls what happens to the dividends that your investments earn. This is the cash that companies pay out on their profits to their shareholders, i.e. you. Here's the types. One is an income class, or INC. That seems obvious when you see it on screen, but when you see it in a fact sheet, you don't always know that it means income. An income fund pays cash into your account, and this cash just sits there unless you reinvest it. It's good for people who need the money now for paying bills or living costs. And then there's the accumulation class, AC. And again, it seems obvious now you see it on screen, but in a fact sheet, when you just see ACC, I used to ignore it until I realized what it meant. In this type of fund, those dividends, that cash that comes to you, it just gets reinvested instead of getting paid out to you. Those payouts buy more unit funds automatically. And this is for anyone that doesn't need that cash now and wants bigger growth. This is compounding in action. My rule is, if I need the income, I'll choose an INC fund, an income class fund. If I don't need it, and I don't because I don't depend on my investments for income for my day-to-day living costs, then I choose an AC, an accumulation class of fund. Just check it once and then only review it when your life circumstances change. So here's a quick recap. Cut fees. Watch the fees that any type of investment is charging you and keep it as low as possible. Like we saw before, a 1% fee, which is seemingly low, isn't necessarily what you think it is. I like to find a good index fund on a low-cost platform. Avoid doubling down on your investments by accident. Check those top holdings to make sure that you are actually investing across different things. Use your ISA or equivalent where you are to keep returns tax-free, to keep your gains tax-free, unless you are feeling particularly generous towards a taxman, that is. Invest monthly and stay invested. Timing the market is for fools. There, I said it. And give your investments time to compound. Let time, the magic of time, work for you. This is probably the easiest thing to do, but the one that just doesn't come as easy to people. Just don't touch it once you've invested, unless you've got a damn good reason to. And for me, that bonus one, pick accumulation or an AC fund, unless you really need the cash payouts regularly. If this video has saved you money, then please tap the like button, and this will help the video reach more people just like you. And do subscribe for clear money videos every single week. These were investing mistakes, but there are other types of money mistakes too. If you want to stop money leaks from draining your bank account, get your cash organized and working for you, and take control with simple, powerful automation, then this is the video you want to watch next.